Imagine a world where digital assets, such as cryptocurrencies, tokenized real-world assets, and stablecoins, are not just experimental or on the fringes, but are instead fundamental building blocks of the global financial system. Picture these technologies being used every day by people, businesses, and governments around the world. In this world, institutions, governments, and regulators do not view cryptocurrency as a lawless frontier, but rather as a new landscape to shape, guide, and integrate into the mainstream economy. The focus is on building trust, security, and opportunity for everyone, not just for early adopters or tech experts. This future is not far away. In fact, it is rapidly approaching. Hong Kong, among other leading cities, is positioning itself as a central hub for this transformation, where digital assets are becoming a core part of finance, investment, and innovation. Microbit Capital has officially launched exchange-traded funds for both Bitcoin and Ether in Hong Kong. This move marks a significant step in the growing acceptance of digital assets by major financial institutions. Institutional investors are no longer just experimenting with cryptocurrencies. Recent surveys indicate that many plan to allocate more than 5% of their total assets to digital currencies. According to research by EY Parthenon and Coinbase, nearly 60% of institutions intend to make such allocations, reflecting a major shift in investment strategy. The Asia-Pacific region is now the fastest-growing area for on-chain cryptocurrency activity. In the past year, the total value of digital assets received in this region has increased by approximately 69% compared to the previous year. In the United States, the market for Bitcoin exchange-traded funds alone has assets under management totaling between $120 billion and $180 billion. This makes it the largest and most dominant market for these products worldwide. Public ownership of cryptocurrencies is also on the rise. In countries such as the United Kingdom, the United States, and Singapore, about 24% of people reported owning digital assets in the year 2025, compared to roughly 20% in previous years. In August 2025, Hong Kong enacted its Stablecoins Ordinance, a new law that brings stablecoins, digital currencies designed to maintain a stable value, under strict regulatory supervision. This move places Hong Kong at the forefront of digital asset oversight in Asia. The government is also developing a licensing system for companies that deal in virtual assets, including dealers, custodians, and those offering tokenized securities or real-world assets. These new rules are designed to clarify who can operate in the market and how they must protect investors. In a recent policy address, the chief executive of Hong Kong outlined a clear vision: expand digital asset products for professional investors, strengthen protections for all investors, and increase cooperation with other countries to fight tax evasion and illegal financial activities. These steps are meant to make Hong Kong a safer and more attractive place for digital finance. The result of these efforts is greater regulatory clarity, which gives institutions and high-net-worth individuals more confidence to participate. With less uncertainty and risk, there is more liquidity in the market, more new products, and faster development of tokenization and other financial innovations. To understand why Hong Kong is significant in the world of digital assets, we need to compare its approach to regulation with those of other major regions and countries around the globe. In the United Kingdom, regulators are currently working on proposed rules for the issuance of stablecoins and the custody of cryptocurrencies. They are conducting public consultations to gather feedback and shape these new regulations. In the United States, the Guiding and Establishing National Innovation for United States Stablecoins Act, also known as the Genius Act, sets up both federal and state-level oversight for stablecoins. This means that stablecoin issuers must comply with rules from both the national government and individual states. The European Union has implemented the Markets in Crypto Assets Regulation, or MiCA, which has been fully enforced since December of the year 2024. This regulation provides a broad and clear framework for stablecoins, tokenized assets, and other digital financial products across all member countries. There are important points of difference between these regions. These include which types of digital assets are covered by the rules, the requirements for reserves and transparency, how cross-border transactions are managed, and how rules for custody and anti-money laundering or countering the financing of terrorism, often called AML and CFT, are applied. Regulatory fragmentation remains a major challenge. Different rules in different places make it harder for companies to operate globally. Sometimes stablecoins that work across borders are removed from certain markets if they do not meet local requirements. Real-world asset tokenization holds significant promise. This means converting assets like real estate, private equity, and government debt into digital tokens, which allows for fractional ownership, improved liquidity, and markets that operate around the clock every day of the week. However, research indicates that liquidity remains limited for many tokenized assets. In other words, many of these assets are not frequently traded on secondary markets, so the benefits are not yet fully realized. Stablecoins are increasingly becoming part of the financial infrastructure. Rather than being used only for speculation, in many countries, stablecoins are now used for payments, cross-border remittances, and programmable money that can be tailored for specific uses. There is a growing academic discussion about what are called hybrid monetary ecosystems. This refers to how traditional government-issued money, central bank digital currencies, and privately issued stablecoins might coexist or work together in the future. Market risks, price volatility, and caution among institutions remain important factors. Cryptocurrencies are still highly volatile, and major failures, such as the collapse of FTX and Luna, are recent events that continue to influence how institutions view the market. Regulatory risk is a real concern. When financial rules change, digital assets can be removed from trading platforms, and the costs of compliance for companies can increase sharply. Risks related to the safe storage of assets, known as custody risk, and risks in how organizations are managed, called governance risk, are still significant and must be addressed. Regulatory arbitrage and harmonization are ongoing challenges. Because the United States, European Union, Hong Kong, United Kingdom, and other regions have different regulatory systems, some companies may choose to operate in places with more favorable rules. However, this can create problems with consistency, investor protection, and supervision across borders. Risks such as cross-border tax evasion and money laundering are on the radar of regulators. Many regulatory frameworks are being developed to address these issues, using anti-money laundering and counter-financing of terrorism rules, surveillance technology, and automated reporting. For example, Hong Kong is increasing its cooperation in this area. Mainstream acceptance of cryptocurrency is accelerating. Digital assets are moving further into investment portfolios, not just as speculative side bets, but as strategic allocations for risk diversification and as a hedge against inflation. Investment funds, family offices, and multinational corporations are increasingly including cryptocurrencies and other digital assets as part of their core holdings. This shift is not limited to a single region. Across Asia Pacific, Europe, and North America, more institutional investors are treating digital assets as a legitimate part of their long-term strategies. New financial products are emerging, including tokenized real estate, tokenized private equity, tokenized debt, and tokenized infrastructure. There are more exchange-traded funds, exchange-traded products, and investment funds that include cryptocurrency. Yield-oriented structures, such as those found in decentralized finance, are becoming more common as regulatory risks become clearer. These innovations are making it easier for both institutional and individual investors to access a wider range of assets with greater transparency and efficiency than ever before. Payments and cross-border finance are also evolving. Stablecoins and tokenized payment systems have the potential to reduce friction, lower costs, and speed up cross-border money transfers. This could be especially beneficial for emerging markets where access to traditional banking is limited. Hybrid money systems are on the horizon. Central bank digital currencies, stablecoins, and cryptocurrencies together could drive innovation in the money supply, enable programmable financial transactions, and promote greater financial inclusion for people around the world. Regulatory frameworks are becoming a competitive advantage. Cities and jurisdictions with clear, forward-looking regulation, such as Hong Kong, Singapore, and several in the European Union, may become global hubs for digital asset capital, attracting institutions, companies, and talented professionals. As adoption of digital assets grows, investor education and protection are more important than ever. Ensuring transparency, robust risk models, strong governance, thorough auditing, and secure custody solutions is essential to building trust in this new financial landscape. When financial markets go through downturns or periods of instability, how well do exchange-traded fund structures, stablecoin price pegs, and markets for tokenized assets hold up? Are these digital financial products resilient enough to withstand major changes in the economy, or do they face unique risks compared to traditional investments? Environmental concerns are also in the spotlight. The energy use of blockchain networks, especially those using proof-of-work systems, is often compared to the energy consumption of entire countries. How will the debate between proof-of-work and proof-of-stake methods continue to shape public perception and government regulation of cryptocurrencies? Another open question is about decentralization. Are we truly building a new, open financial system, or are we simply recreating the traditional world of large financial institutions like Wall Street, using blockchain technology as a wrapper? The answer will shape the future of digital finance. Privacy and data security are critical concerns. As digital assets become more common, how will personal information be protected, especially with requirements for Know Your Customer rules and anti-money laundering regulations? Striking the right balance between transparency and privacy is a major challenge for regulators and the industry. Finally, will countries and regions around the world coordinate their rules for digital assets? Or will we see continued fragmentation? If global cooperation does not happen, regulatory arbitrage, where companies move to the most favorable jurisdictions, or even regulatory conflict could become more common, affecting the growth and safety of digital finance. We are at a pivotal moment in financial history. Cryptocurrencies and other digital assets are no longer just speculative investments. They are becoming part of the very foundation of global finance, as infrastructure, as vehicles for investment, and as engines of innovation. This transformation is not limited to experts or insiders. It is shaping the way everyday people, businesses, and governments interact with money and value. Hong Kong's leadership in regulating digital assets is just one example of a much larger global shift. The city's approach is helping to bring clarity, legitimacy, and mainstream trust to digital assets. This is not just about local policy. It is about setting a standard that other financial centers may follow as the world adapts to new forms of money and investment. If all the key elements come together, robust regulation, active participation from institutions, ongoing product innovation, and reliable infrastructure, then digital assets could fundamentally reshape what investing looks like over the next 10 years. The potential is enormous, but it depends on cooperation and careful planning across the financial industry. The journey ahead will not be easy. There will be volatility in the markets, unexpected changes in regulations, and challenges in governance. What truly matters is building financial markets that are resilient, transparent, and accessible to everyone. Only then can digital assets reach their full potential and benefit society as a whole. Which country or region do you believe will lead the world in digital asset finance over the next 5 years? If you were managing investments for an institution, what would you need to feel confident about allocating 5% to 10% of your portfolio to cryptocurrencies or tokenized assets? And how important do you think stablecoins will become in everyday payments compared to their role as investments? Share your thoughts in the comments below. This video is for general information only and does not constitute financial advice. For personal guidance, please consult a licensed professional. If you found this video helpful, please subscribe, like, comment, and share.